While there still continues to be very few Black VCs in the industry, we recognize that if we are not proactively leaning into our own people, our Black entrepreneurs, then on the one hand, it's not helping them obviously raise capital, but it's also they're not feeling as if their product, their vision is being heard.
If you can define for me, we hear the word fund thrown around a lot, specifically when you're talking about tech startups. Can you define what a fund is?
Yeah, so first, it's great to be on. Well, so a venture capital fund, a fund, is essentially a pool of capital that is, so you're an institution, you're managing other people's capital, and it can come from different types of entities, right? You have private foundations, you have high net worth individuals, you have university endowments, corporations, fund of funds, sovereign wealth funds, pension funds. So these are entities that seek to invest in managers such as myself or venture capitalists, to execute a strategy, right? That with the goal of producing top decile, top quartile returns. So whatever those limited partners, what they call themselves, limited partners invest in the general partner. Whatever dollar amount they invest into that fund, their hopes is to get a 5, 10, 12, 20x return back in their capital. And they do that by way of evaluating fund managers such as myself, who have unique strategies that allow them to go out and source, invest, and help scale early stage entrepreneurs, growth stage entrepreneurs, depending on their stage of investment focus. And so, yeah, that's an example of a venture fund. Again, two entities. You have the general partner, you have limited partners. General partners go out and fundraise from limited partners. Limited partners believe in the mission, believe in the thesis, and that allows the general partner to go out and put that capital to work.
And so if you can starkly define the difference between that and an angel investor for our audience, could you do that?
Yeah. Angel investing is, first of all, it's an accredited investor. These are typically high net worth individuals that believe today an accredited investor is defined as someone of $250,000 in I believe it's in annual income. I believe if you're two individuals is 350, and then $1 million in net worth, I believe, is labeled as an accredited investor. But in an angel investor, you have full autonomy over your own capital. You're not reporting into a limited partners like a venture fund. You can invest in as many companies you can. You may have your own strategy in terms of your check size and the type of category sectors you feel comfortable investing in, thematic themes. You may want to focus on women and people of color, for example. But you typically, it's your own capital. I think another component of angel investing is that you often partner with other angels as well, which is called an angel syndicate. Essentially, the ability to consolidate your capital into a financing round that allows you to be a bit more competitive into getting into competitive deals. And so maybe your $10,000 or your $25,000 check won't move the needle into a certain company that's raising. But if you can collaborate with other angel investors and convert encourage your $25,000 to go into a total of a $500,000 pool of capital with other individuals, that's a more competitive or and also strategic way of joining a cap table. As it relates to an institutional fund, again, you're reporting into you're partnering with other limited partners, as I alluded to earlier. But then you also have a very strict strategy. You have a portfolio construction that you have to really important that you abide by. There is reporting mechanisms. You have an annual meeting. You have quarterly reporting, financial reporting. You have updates on the market that you want to share to your LPs. So it's a more structure way of deploying capital, just given that you have other partners who are believing in you to manage their money and be good, great stewards of capital in efforts to return their capital again 5, 10, 15, 20x. And so there's autonomy, and then there's like this way of being a bit more structured.
Yeah, and you've said a couple of terms that I want to be clear with, that we define also is the idea of a limited partner and the general partner. Can you describe what those are?
Yeah, so the limited partner will is the money behind the money. Is what people like to call it. It is the capital that allows the general partner to go out and invest in companies. And so the limited partner again is several types of entities. There are university endowments. So for Zeal, for example, we have 56 limited partners, most of which are high net worth individuals, as I defined earlier. But we also have HBCUs like Hampton University, right? We have private foundations like Sloan and Alpha P Sloan Foundation and Skoll Foundation. We have institutions or corporations like PayPal and Bank of America, Synchrony Financial, Truist, our largest investor. And then we have technology companies like Google as well, and family offices like Gary Community Investments. So these are entities, family offices, corporations, technology companies, university endowments like HBCUs, and family offices like Gary Community Investments. And then like notable individuals such as Jason Green from Emergence, Mark Perry from NEA, Josh Copeland from First Round Capital, just to name a few who have many view as the storied investors who use their personal capital to invest as a limited partner into the GP. The GP is myself. I manage the fund. I manage their capital and also the operations of the day-to-day venture, Zeal, the venture fund itself. And so that's everything from sourcing to conducting diligence to writing the investment memo, going to our IC, our investment committee that gives us the thumbs up, thumbs down to move forward on the deal. And so it's the operational day-to-day is what the GP essentially manages. And so those are the two differences. But it's so important that the GP is overly communicating, is in close contact with the LPs. I think what's also really unique about, at least for Zeal, is that our limited partners are not just they're not just investing in the fund, but they are also what we call, you call strategic or mission aligned investors. So we have 4 other banks. We have Truist, Bank of America, Synchrony Financial, and Bank of Truist, Bank of America, Synchrony Financial, and PayPal. So these are our strategic investors. Given that we're investing in the fintech category, they support us outside of capital. They help us think about the market dynamics across the fintech industry to as well as offering other resources internally as well. So that really that increases our value proposition to founders as we look to look to add more than just capital to our founders. They're not just getting Zeal, the investment team, but they're also getting the extension of our Zeal family, and that being our limited partners.
And so, when you look at a lot of the backgrounds of people who are GPs in a fund, they run funds. So you think about, I mean, they run the gamut of backgrounds. They've been startup founders, they've been, through business school, and they just went right into investing. Who should
Right.
consider starting a fund?
You know, first of all, I firmly believe, and I am a prime witness of, indicator of it, that there's no cookie cutter approach in starting a venture fund. You don't have to go to business. I didn't go to business school. You don't have to be a graduate of the premier universities, for example. I do think it is important for you to have your arms wrapped around the entrepreneurial ecosystem, recognizing where to find startups, right? And for you to build a reputation, a relationship with that ecosystem, with those founders. I think people talk about track record, and it usually, and rightfully so, it does mean what's your track record in terms of investing in quality companies that have gone on to outperform, realize returns, and become unicorns and go on to exit, et cetera. And that's usually a great indicator of your investment acumen. But I also think that the indicator of an excellent track record are those who have unique deal flow, right? Your ability to source companies, not just come from very few places, but your unique reputation and leadership across ecosystems that unfortunately have been left out, and also yield investable entrepreneurs, many of which are women and people of color, for example. And so I do think those that have the strong reputation across the broader entrepreneurial community is very important. I think one who I do think it does help that you've managed to, whether it's your own personal capital or you've raised a small chunk of capital, to put that capital to work and not only invest capital into those companies, but to share to LPs your narrative around the value add you did for those companies, right? What was the very specific value add you added to those companies, whether it was helping them build their team or helping them think thoughtfully about their go-to-market strategy, helping them think thoughtfully about their product, their brand management, getting their product into the market, getting them as a leader into the market, making sure that they're positioning themselves as a market leader. And so that those are positive signals that you can be a great candidate to start a fund. Now, I do think there takes a good skill sets, right? I mean, you can have your arms wrapped around the entrepreneurial ecosystem, but but probably not have the best investment acumen in terms of how to think about term sheets, how to think about your investment memos, how to manage your LPs, how to even go out and know where to find LPs. I think there's a certain type of the beauty of having a possible co-founder is important. And so I think that could be very beneficial of not only just having someone who has their arm wrapped around a unique entrepreneurial ecosystem, but also someone who has some form of investment acumen, who understands the ins and outs of putting capital to work, is important as well.
So when you think about particularly black VCs, how important to black founders is it to have people, from our backgrounds, perhaps from our perspectives, because we're not all monolithic, but perhaps who, may be a little bit more willing to hear these stories. So we hear so often about, if I came to you with something, let's say, a wellness product or a beauty product, we hear these stories
Right,
of VCs saying, well, is there really a market for that? Obviously, there's a market for that, but we've heard these horror stories.
right,
So, how important is
right.
Black VC?
Well, it's so important because it's at least, and we all talk the few, while there still continues to be very few black VCs in the industry, we recognize that if we are not proactively leaning into our own people, our black entrepreneurs, then on the one hand, it's not helping them obviously raise capital, but it's also they're not feeling as if their product, their vision is being heard, and in many cases, as you alluded to, there are industries that we actually do understand more so because of personal experiences. And when you are, I do think there is a responsibility as a black investor to lean into culturally relevant um, ideas that unfortunately most, I would say, white investors probably would not understand based on their lack of personal experiences. And so there is there is power in black VCs looking to invest in black entrepreneurs, especially in ideas that we understand the market opportunity, we understand the overall demand, that there are people that are willing, particularly black folk, people of color who are willing to pay for this product. But yeah, I think it's incredibly important. I think it's power when black VCs have the capabilities to and the autonomy to deploy capital into black entrepreneurs, and I think it's more so because we understand we understand more clearly than a traditional investor on especially as it relates to some of the more culturally relevant unique tools and ideas that we see a demand, and that unfortunately traditional investors haven't had the fortitude, mainly because of personal experiences. And so, but it's exciting because we also see, well, we continue to hear those horror stories. We see islands of excellence. We see companies that have gone on to do quite well in the beauty space, in the e-commerce space, where there continues to be a great deal of demand from Black folk in general in terms of consumer base.
You talked a little bit about like kind of the prerequisites, if I can use that word, of what it takes to get in the game from an investment perspective, from being a GP. Um, that's kind of just getting in the game. What is, because there's a difference between the quantity and quality of people that you see from black investors at the seed stage versus Series A, and then even less of us at Series B, and very, very, very few of us
Yeah.
at the Series C. What are the prerequisites to graduate to those next levels of venture capital investing?
You got to produce a top decile return. I mean, you have to produce your portfolio has to be strong. Like my boss, the GP's bosses are LPs, right? We can't move forward if our fund is not high performing, which is why it is important that while we're proactively leaning into more African American and Latinx BIPOC entrepreneurs, it's important that we're investing in quality investable entrepreneurs that we believe will, and this is from a GP's lens, an investor's lens, will be a top tier, a top performer in our portfolio that will return the entire fund. Right, is what we often seek in every entrepreneur and every founder that we invest in. And so, in order for us to continue to elevate from stage, whether you call it stage or just from fund one all the way to fund five and beyond. We have to. It's important that we produce a top decile, top quartile at the very least, fund performance. Now, you're alluding to different stages. Now, I think it's important to note that there are some venture funds who prefer, like myself, that I think the best stage is early stage, and that's where I just get excited the most. I never to be in this the duration of my time in this business. I do not foresee myself going into growth stage, Series B and beyond. I enjoy. I think there continues to be a great deal of opportunity and getting excited by way of partnering with companies who are from napkin to post product to early signs of revenue, and I think that sweet spot is incredibly important. Now, I do think as you build your investment franchise, your platform, you start to gain access to deals that are later stage, right? And I do think, so, sort of to my earlier point on having a unique strategy, having access to early stage entrepreneurs. If you can prove to your LPs that you too also have early access to later stage deals, now you're able to build a full investment franchise that will allow you to make sizable investments into later stage deals. Now, the difference now is that your LPs are writing, your fund itself is much larger than a 60 million-ish dollar fund that we have. Your fund is going to have to be 200, 250, 500 million, maybe $1 billion dollar fund in order for you to write a sizable check that allows you to have significant ownership. So when that fund, when that company outperforms, goes public or gets acquired, you can reap the benefits from that company, given that you wrote a sizable check. But you can't write a small check into a Series B company, just given the valuation. More than likely, it's going to be $1 billion, between a half to $1 billion valuation. And so it just requires a different type of infrastructure as you matriculate into the later stage space. But the sweet spot for us is early stage for sure. And I don't see, at least today, ourselves going into the later stage space.
You mentioned your fund's $60 million fund. This is your debut fund, and one of the largest by a solo GP to date. And you were initially just targeting 25 million, if I understand that correctly. Why all the demand? Why the oversubscription? Why is all this money flowing into Nasir?
Will, when I first started, I took a step back and recognized the supply and demand. The demand that continues to exist across the two categories that I've been leaning in over the past 7 years, which has been the future of work. So the role that technology plays to narrow the skills gap between education and employment pathways. And from a financial technology perspective, the role that financial technology could play to remove barriers and provide access to the and underbanked consumer. But at the same time, that's mission, and obviously there's a clear impact there, but constantly seeing also market demand across these two verticals as well. So Warren Buffett says, stay within your competency, do that well, and then scale. I think you find most venture funds going out to be generalists. I chose to be a category specific fund that builds on top of my track record after the past 7-8 years, where I was head of education, head of U.S. Economic Opportunity Fund at Village Capital, and then led AT&T's $400 million investment fund, did some angel investing, as you alluded to earlier. So I built up not just a reputation across the entrepreneurial ecosystem, particularly though ecosystems are outside of Silicon Valley, outside of New York and Boston, but didn't ignore those ecosystems, but you kind of ensure that my lens was more inclusive, that I was tapping into entrepreneurs who were high quality investable entrepreneurs and invested put that capital to work and invested in those companies. So that within that experience yielded a top quartile track record. And then on top of that, I did feel that I was able to pull together a strong infrastructure to also get around the challenge of a solo GP that is very challenging in no matter if you're a diverse manager or not. Like, it is challenging to raise a fund, to build a company based on a number of risk factors, right? And so it was important that I had a strong advisory board, I had a strong operating partners as it relates to post-investment value creation, EIRs, my two executive and and residents, both focusing on fintech and future of work, and analysts and a principal was very important. And then most importantly, limited partners that were strategic. These were fintech limited partners. They were financial services limited partners. They were university endowments. They were membership organizations like the Society for HR and Management that coincides with our future of work category. So being very intentional in terms of how I thought about the strategy, and recognizing that there are companies that are continuing to innovate across these two sectors, and then also building out the infrastructure that allows us to fully support these entrepreneurs once they become Zeal investment partners, and then helping them reach their full potential and reach scale. And so that resonated. I think the last thing I would say is that our inclusive investing strategy resonated as well. I mean, that's our unique strategy that allows us to widen our lens and best position our companies to outperform, which is a 5-pronged market back approach that I believe that is our North Star. I believe inclusive investing is no matter if you're a storied franchise like Andreessen or Lightspeed, or you're an emerging manager. I think if you implement this inclusive investing strategy, it will further democratize entrepreneurship and access to capital, where you find more women and people of color getting a fair swing of the plate at capital. And I am just unapologetic there. I truly believe that there has to be a intentional way of thinking that debunks traditional way of sourcing and investing in companies. And I firmly believe that inclusive investing, when you lead with inclusion, beginning with your team, that allows you to over-index your allocation of more women, people of color. We partner with 24 entrepreneur support organizations across the country. So geographic inclusivity, right? These are ESOs, these are accelerator programs, incubators. Then there's your number 4 is your investment focus, which is fintech and future of work. And number 5 is impact. We have very specific impact metrics. We are capturing 9 out of the 17 global sustainable development goals. Every founder is signing a diversity pledge. You're also scaling, ensuring that you're looking to scale your product and service into a under-resourced community or on behalf of an underbanked consumer, depending on your business model. And so I think the infrastructure and the strategy and the team I've been able to pull together has resonated with our limited partners, which yielded a pretty substantial investment fund.
You alluded to this earlier. My final question. You talked a little bit about the reporting and the meetings that you have to do, the structure of a venture capital fund. And I wonder, because we talk so much about, the personal general partner's mission to go out and do things about, making the equity that Black founders have, with capital they have to be able to build their businesses. Does a
Right.
GP, or actually a better question maybe is, when does a GP have free will to write a check versus having to go back to LPs, and or is that how it works?
Mm-hmm.
Does a GP have to go convince the LPs that this is an investment we should make?
Yeah. That's it. So first, the LP invested in the GP because the LP believes in him or her, believes that they're going to fully execute the strategy in which they pitched to the LP, right? And so for us, for example, we're focusing on companies that are led by diverse management teams that are rethinking the building blocks of wealth, from education to employment pathways to financial wellness. So fintech and future of work. Now, if Nasir decides to go off and invest in an energy company, that wouldn't flow, right? That would go outside of the strategy. And so, unless
But is
what
the
could
GP
happen.
asking permission? But is the GP asking permission to before he writes that check, or does he have to answer when he gets to the meeting that, hey, you wrote this check, what's up with this?
No, no. So the only way a GP will have to ask for permission back to the LPs, which is called the LPAC, right? So your LPAC is your um, um, limited partner committee. Essentially, it's four or five, usually no more than five investors, five limited partners who are your largest investors. So anytime you have a one-off deal or a deal that's totally outside your strategy, you go to your LPAC committee and you explain the deal, you explain the economics, the parameters, and how much you would consider underwriting. Um, and again, this is a deal that's outside of your strategy, and you get permission by your LPAC to move forward on that deal, right? But that rarely happens, especially as a first time fund manager. As a first time fund manager, you want to stay within your strategy. You want to focus. You want to practice what you've shared. You want to execute what you shared to your LPs, and for that, Will, there is no reason I should never have to go back. I should never go to my LPs for every deal I choose to invest in. Your LPs are trusting you with their capital, and when you choose to invest into these companies that align with your strategy, now who you do report to, who most GPs do report to, is what you call your IC, your investment committee. And so your IC essentially are individuals who are either, sometimes they can be your LPs, some usually they're not your LPs, they're thought leaders, within the VC, or they may have strong domain expertise in that particular category that can shape your thinking on check your blind spots. But it's usually, depending on how your IC is set up, they usually vote for that company to move forward, or they don't, and they give their reasons why. Um, but usually the GP has final say so. In our case, I have final say so on every deal. Like, they can share their disagreement on a deal, but Nasir has final say so on whether or not I would like to move forward with an investment in that deal. And so far, we have never had a deal out of 9 deals so far. We haven't had a deal where an IC member has said, no, I don't think this is a great deal, reconsider. So going back to your point, I think the beauty of being a GP is that you have autonomy. You have autonomy to approve deals that will change the trajectory of this founder. Putting 1 million, putting 2 million in, that will allow them to fully execute their strategy, build their team, build on top of their current product. And so I think that's the beauty of being a venture capital, as well, is to be entrusted with limited partners capital, be great stewards of capital, and underwrite that capital into entrepreneurs who align with your strategy, and then you and then you go to work. That's where the real work happens, because you start to add post-investment value creation into that founder outside of capital.